Let's talk markets. Joining us now, Anastasia Amoroso, Chief Investment Strategist at iCapital. Good to see you.
Good to
morning.
See you, Joe.
In
Good
studio.
Morning.
Inflation ever worry you anymore, or we've definitely shifted to growth concerns?
It seems like it's not the one that matters anymore. I mean, we are expecting an inline print of 3.2% core CPI, and I think that's good enough. I mean, importantly, we do see the 3 months annualized inflation that's coming down quite significantly, more so than the 6 months number. So I think that should provide support for the case for the Fed to cut interest rates. But you're right, Joe. It's not about inflation anymore. It's more about the growth concerns. And, you know, so far, what's unnerved the markets in this first week of September is that we're once again on the recession watch and the recession obsession, as I call it, only because the labor market seems to be weakening more than expected. So that's the driver in the markets right now. Personally, I don't subscribe to the view that we are headed for a recession. I think this economy is slowing, but it is still growing. And outside of the unemployment rate, you look at the range of economic indicators, and they're not implying high odds of a recession.
If the Fed were able to start its cutting cycle with a 25 basis point cut, that would be very positive, that it didn't have to do what it thought was anything more substantial than that, because things are going pretty well and under control. Will the markets test the Fed and push the Fed? I mean, good day yesterday, but last week I started wondering whether the markets were going to push the Fed to a 50 basis point.
Well, they may try. They try. And, you know, there's a 50-50 chance that the markets are pricing in that we get a 50 basis point cut right now. So they certainly do try that. But the Fed is not really easily pushed around. And, you know, Joe, what we have right now is not a state of an emergency. You know, we have somewhat weakening labor market. We have inflation that's under control. GDP is still growing 2%. So things are actually in check. So I'm hard-pressed to think that the Fed is going to say, let's do 50 basis points.
It's too good to be true, though, Anastasia, isn't it?
Well, I mean, well, maybe it's slowing, so maybe it's not as good as it was once was.
But it's a very great place for the Fed to be.
Yeah, I think it's a very great place for the Fed to be. And, you know, 50 basis points on the one hand can signal that they see something that the rest of the market participants don't. So in a way, I don't actually want to see the 50. But you could also make the case that, well, they do have a lot of room to cut. They probably have 250 basis points to work with to get back to neutral. So if they want to kickstart this cutting cycle with 50, that's fine. But here's what I would say broadly for the markets. You know, it's not 25 or 50 basis points that matters. What matters is that we are in the beginning of a rate cutting cycle that's likely to go on for some time, and it is already providing relief to various parts of the economy, not just the markets, but the economy. And if you look at the 6-month SOFR rate, for example, it was 5.4% a year ago. It's about 4.5% today. You know, if you think about your floating rate loans that are based off of that, they're already adjusting lower. And so eventually this is going to boost demand for credit. And actually, I shouldn't say eventually, because it is already boosting demand for certain loans, for commercial and industrial loans, for example. So I think the knock-on effects from a rate cutting cycle, whether it starts with 25 or 50 basis points, that knock-on effect is going to be strong in the coming months.